I love covered calls. I'm kind of a cheap guy, and covered calls lets me lower my cost basis on a stock over time. I've previously done a few episodes on in the money covered calls, where your covered call is holding back your profits. So in this episode, I'm showing an example of covered calls helping your profits. First, I'll give a quick description of covered calls. Then I'll show an example of how I've used covered calls to significantly lower my cost basis on one of my stocks, Moderna. And finally, I'll talk more about cost basis, how I use it and how I don't use it. I've seen some YouTubes about covered calls that, in my opinion, misuse cost basis. Yeah, it's true. Some YouTube creators use cost basis as a crucial factor in making decisions about where to put their strike price. This is a mistake, and I'll explain why towards the end of this episode. So let's start by briefly explaining a covered call. Here's the Investopedia definition. An options trading strategy, which the trader sells a call option while also owning the underlying security. It's covered because you already own the stock and are covered in that way. You own 100 shares that are waiting in case the stock shoots up and gets called away at expiration. If you didn't already own the 100 shares of stock, it would be naked and risky. If the stock would shoot up, you'd have to go out to the market and buy 100 shares at whatever the current market price is. That could be painful and you could lose a lot of money. So this is a safe strategy. You are sacrificing potential upside to get some premium when you sell a covered call. This is the risk and downside of covered calls. You may miss out on a big rise in the stock. There is also a risk of the stock going lower, but you'd have this risk whether you sold the covered call or not. The premium you collect will cushion the downside of the stock a little. Selling covered calls is actually a little safer than just owning the stock without the covered call, but you're limiting your upside. That's the catch. I'm assuming you already know something about covered calls. If this is totally new to you, there are lots of good and bad information about them on YouTube and other places, books, internet, etc. See the links in the description for some good YouTubes about covered calls. Now let's show an example of how I've used covered calls on my Moderna stock to significantly lower my cost basis over the last few years. But first, if you're enjoying this content, please consider liking and subscribing. Covered calls and their adjustments, typically rolls, will fall into three categories over their lifetime. First, the underlying can go up too fast. We can call this the too hot category. This is a good outcome for you. It's just a little bit annoying because your covered call can go in the money or deep in the money and can hold back your profits. I've linked a few episodes about this case in the description with some thoughts on what to do about it. Second, the underlying can go down. It can go down much faster than the amount of premium you're collecting from your covered calls. We call this the too cold category. This is bad, but at least the covered call will provide some cushion to the fall and you'll be doing better than you would have without the out of the money covered call. And third, the underlying can end up pretty close to your strike price. The premium you've collected will be an extra bonus to the stock price appreciation, or it will more than offset the small losses of your underlying. We call this the just right category. This makes you feel smart because things are going just as planned. Your covered call is making money and your underlying is very close to the strike price at the money just before expiration. It's in great position for you to either roll or wait and see if it gets called away. My transactions with Moderna over the last few years will illustrate all three of these cases. I've always adjusted by rolling or sold additional covered calls along with selling puts if I'd like to buy more shares. So far it's paid off by significantly lowering my cost basis over time. Here's a quick view of my transaction log from when I started selling puts on Moderna back in October of 2021 through today, May 27, 2024. We'll look at a couple charts next to visualize this log. It's a total of 66 transactions, but many of these can be condensed into rolls, or a single transaction that my broker separated for execution. I've managed to lower my cost basis from 240 when I was first assigned all the way down to about 118 on May 22nd. Here's a chart just showing the transactions where I bought 100 shares of Moderna twice. So if I'd sold no options and collected no premium, my average cost basis would be $220. That's 100 shares at $260 and 100 shares at $160. It averages out to $220. Moderna is currently selling for $166. So that's a loss of $54 per share over about 2.5 years. Thankfully, selling options has helped significantly. Here's a big ugly chart with all my transactions annotated and showing my cost basis over time. The y-axis shows the price and cost basis of Moderna, far right here. Moderna is currently selling for $166 per share. You can see its price over time in the blue background behind all the lines here. The purple lines are puts, selling, rolling, and buying to close. The blue lines are covered calls, selling and rolling. These horizontal blue lines are the call strike price. Notice sometimes, like over here, the strike price is below the cost basis line. Let's focus on the yellow line here. It shows how my cost basis has gone down over time each time I sold a put or a covered call or did a credit roll. Moderna pays no dividend. If it did, those would also lower the cost basis. I've marked a few places along the yellow line showing my cost basis. Here's when I first got assigned 100 shares from selling some puts. The strike was $260, but I had already collected $19 per share in put premium when I was assigned, hence the $241 cost basis. Then I sold more puts and started selling covered calls and got assigned another 100 shares here at a $160 strike. By this time, my cost basis was down to $178 per share. Then I sold more puts and calls until here, my last sold put. My cost basis was around $150 here when I closed out my last short put. Up until this point, my strikes had been above my cost basis. This was the case for several more months of just selling and rolling covered calls, all the way until here, when I started selling calls with strikes below my cost basis. Why did I do this? Why set the strike below my cost basis? Isn't this a no-no according to a lot of option YouTubers? I did it for a couple reasons. First, I wasn't as bullish on Moderna anymore. They were quickly burning through their cash pile they made during COVID and weren't releasing any good news on new products coming out of their pipeline. Second, Moderna has volatility, more than your typical stock. So I knew if it shot up quickly, I'd be able to roll up and out to a significantly higher strike price. This second scenario has finally played out here in May. And I've rolled up and out twice all the way to the 200 strike, expiring in January of 2026. If Moderna keeps going up, I'll have one more card to play in September when new leap options come out for 2027. I'll consider rolling up and out again then, or maybe just let it get called away in January 2026 at 200. One thing to note is this $117 cost basis assumes I'm going to hold the current option to expiration, January 2026, over 18 months from now. If I'd want to close out now, I need to add the cost of the current option, $7,470. That works out to about $37 per share. So as of now, the cost basis is approximately $117 plus $37, or $154 per share. So I'm up about $12 per share, $166 minus $154. Now that we've been over my Moderna example, I'd like to share my opinion of how to use your cost basis. I see my cost basis as water under the bridge, toothpaste out of the tube. Your estimate of a company's value should evolve over time. What you paid for it shouldn't affect your current decisions. Your decisions on strike and expiration, whether to close out the position, they should be made on your current view of the company and your goals with your option strategy, income, stock price appreciation, not on your cost basis. Always be watching for new information like earnings reports, news, competition, management changes, etc. and be aware of potential better opportunities. Your cost basis is very important. You should constantly be aware of it and use it to measure your performance and critique your previous decisions. But you shouldn't let it cloud your judgment on current decisions, so don't be tied to your cost basis. Instead, think about what kind of return you'd like to make going forward and what you currently think of the business of the underlying stock. Is it still undervalued? Did you find new information about it? Don't stress over your cost basis being above your current strike price. You're not going to win every stock you buy. All you can do is make your best decision each time based on current information. In conclusion, let me know about your experiences and opinion of how you used cost basis. I really appreciate any feedback or comments. If you enjoyed this content, please consider liking and subscribing. I'm not a financial advisor. This isn't financial advice. This is just some guy sharing his thoughts about covered calls and cost basis on YouTube. And have a profitable day.